Have you ever wondered what causes the wild swings in the stock market? The recent rally and subsequent struggle of stocks might just give us some insight. Let's take a chronological journey through these events to understand better. Our journey begins in the middle of November 2023, when global equity markets were struggling to maintain their recent record highs due to concerns over slowing China growth and a spike in COVID-19 cases in Europe. While US stocks managed to close at a record high, Asian markets were down 1% for the week. The dollar strengthened against major rivals, while the euro remained near 6-year lows against the Swiss franc. Oil prices continued to be volatile, with US crude and Brent crude rising. Fast forward to January 5, 2023, the FTSE 100 index in the UK extended its gains for the second consecutive session, closing at its highest level since February 2020. This rally was driven by a rise in oil and mining stocks. The demand for oil held up despite the Omicron variant of COVID-19. However, the domestically focused mid-cap index fell by 0.5%. Now let's move on to our main event. US stocks began to struggle after a rally, with the S&P 500 near overbought levels. The US Treasury Index was heading towards its best month since March, with slowing inflation and measured jobs growth contributing to a rally. Bets that policymakers were done with rate hikes fueled a rally in the S&P 500, sinking short-term volatility expectations. More than 60% of respondents in a survey expect stocks to provide better returns than bonds over the next month. However, all was not rosy. CrowdStrike Holdings Inc. underscored the prioritization of cybersecurity, while Salesforce Inc. and Dell Technologies Inc. were expected to post slower sales growth. Gold was back above $2,000, while oil dropped due to easing geopolitical tensions and oversupply signals. To summarize this roller coaster ride, the stock market rally was driven by a multitude of factors, including slowing inflation, measured jobs growth, and bets that policymakers were done with rate hikes. However, this rally was not sustainable as stocks began to struggle, with tech giants expecting slower sales growth and oil prices dropping due to easing geopolitical tensions. Despite the volatility, the majority of investors remain optimistic, expecting stocks to provide better returns than bonds over the next month. The takeaway? The stock market is a complex entity influenced by a myriad of factors. It's essential to stay informed and understand these factors to navigate the highs and lows successfully. On this note, we conclude our journey through the recent stock market rally and struggle. Until next time, stay savvy, stay informed.